Bitcoin's price has fallen nearly 50% from its all-time high, and with its price briefly passing below $30,000, it has actually had a negative return for the first time this year. But despite that initial crash, the price has remained relatively stable between around $30,000 and $40,000 per coin, and it has not had a complete 85% meltdown like it has in the past. But there's a potential ticking time bomb within the Bitcoin ecosystem that could bring about a flash crash greater than the coin has seen up until this point. And its name is Tether. No, it's not the most intimidating name, but Tether is a cryptocurrency which many crypto traders use to add liquidity to their Bitcoin trades, using it to buy and sell Bitcoin rather than USD. This lets them skip the process of pulling money in and out of bank accounts with a 3 to 5 day wait each time. This is because Tether is a stable coin, and its price always stays pegged to $1, making it a good alternative for people looking to move money around quickly. But recent allegations against the company behind Tether have recently been brought back to light that show the token might not be worth $1 after all. In fact, it might be completely worthless. If that is true, it would put the entire $62 billion in market cap that Tether currently has at risk. But that's a relatively small concern compared to the much bigger risk that Tether could collapse and take Bitcoin down with it. But let's not get too far ahead of ourselves just yet. Hey everyone, and welcome to FinTech. I'm Finnegan Tekken, that's my legal name, and in this video we're going to be looking into how something as relatively boring as a stablecoin could disrupt the entire crypto space, touching everything from corporate cover-ups to the Colombian cartel to, most exciting of all, market liquidity risk. But seriously, the inspiration for this video came from an amazing video by CoffeeZilla, and this video will be diving deeper into some of the financial aspects that he talks about in his coverage. So hit the like button if you want, and let's start with a brief history of Tether and its founders. Tether was originally founded as a stablecoin. The idea was that every dollar someone put into Tether, Tether would maintain an account where each token in existence could be matched up to $1 in that account. If you wanted to, you could trade in your Tether token for $1. Thus, 1 USDT would always equal 1 USD. The problem was, Tether's terms of service didn't actually say they had to give you $1 back if you asked for it. In fact, they say Tether reserves the right to delay the redemption or withdrawal of Tether tokens if such delay is necessitated by the illiquidity or unavailability or loss of any reserves held by Tether. So if for some reason Tether didn't have the $1 to pay back your token, they could just say, sorry, there are no dollars available right now. Which means the only thing tying Tether to that value of $1 per token is that they say it should be $1 per token. So theoretically, they could just mint new tokens, claim they're worth $1, and make their owners rich without the backing of any USD. Of course, to do this, they would need to act completely fraudulently and to collude with a crypto exchange who would let them trade these new Tether for something like Bitcoin. Enter BitFinex. BitFinex is a crypto exchange, kind of like Coinbase, only with a much more troubled past. They have been investigated and fined by the New York Attorney General. BitFinex on the surface is just another crypto exchange where you can exchange Tether for cryptos like Bitcoin, but there has long been speculation that it held close ties with the owners of Tether. In 2017, BitFinex sued Wells Fargo after the bank froze their ability to make transactions in their account. This meant that BitFinex couldn't give users their money when they wanted to exchange cryptos in, and it meant the company would quickly become insolvent. So what did BitFinex do? They borrowed $600 million from Tether, a supposedly totally unrelated company. In fact, when asked whether or not Tether and BitFinex were owned by the same people, Phil Potter, the co-founder of Tether, said,
So people that are confused right now, basically Tether is Finex, right?
No, it's not, but we bank with the same banks.
I wonder if my fellow bankies at Ally Bank would be willing to loan me $600 million. Well, what Phil Potter said was quickly revealed to be false with the release of the Paradise Papers, which was kind of a smaller follow-up to the Panama Papers, which revealed many of the offshore accounts used by the rich and powerful. Some of the rich and powerful exposed Phil Potter, who it turned out was not only an owner of Tether, he was also an owner of BitFinex as well.
We, BitFinex, are majority owners of Tether. This is true, but Tether is a completely segregated entity. Everything there is 100% kosher.
So now you have a lot of the pieces in play. You have Tether, which has no requirement to maintain a 1-to-1 USD to Tether token cash store, And now you have it tied with a crypto exchange where they could create new tokens out of thin air and use them to buy Bitcoin. But would they do something like that? Well, let me briefly touch on who was involved with these two companies. You had Phil Potter, who in 1997 had this weird interview with the New York Times where he talked about how he earned 6 figures and would spend $300 on a night out. You had Giancarlo Devasini, who had been charged with software piracy in the past. And you had a few more, even more unsavory characters who I won't get into in this video, but CoffeeZilla talks about in more detail. And that's not to mention the people they worked with. BitFinex couldn't use a traditional bank because, especially back in the mid-2010s, banks didn't trust cryptos. So instead, BitFinex banked with a company called Crypto Capital. Some of Crypto Capital's other high-profile clients included the Colombian drug cartel and Backpage, who was busted by the federal government, resulting in the FBI freezing all of Crypto Capital's assets, including BitFinex's money. So now BitFinex had no money and they couldn't get a loan from a bank because banks didn't trust them. So what did they do? They turned to their good buddies at Tether for a small loan to cover their $850 million in lost assets. Good thing their buddies at Tether were quite literally themselves. So that loan covered the shortfall, BitFinex lived to see another day, and Tether just kept its value. Here's where things get weird. That screenshot I showed earlier of Tether's commitment to keeping 1 USD for each token is only visible if you use the Wayback Machine. If you go to their website now, it says, every Tether token is always 100% backed by our reserves, which include traditional currency and cash equivalents, and from time to time may include other assets and receivables from loans made by Tether to third parties, which may include affiliated entities, collectively reserves. Every Tether token is also one-to-one pegged to the dollar. So 1 USDT token is always valued by Tether at 1 USD. Well, that's great that Tether values 1 Tether token at 1 USD, but their reserves are backed by loans? Well, it turns out Tether is one of the largest holders of commercial paper in the world, which is another name for unsecured loans. That means any loan that isn't backed by an asset, like a car or a house. So if the loan isn't paid back, the originator of the loan gets nothing in return. In fact, of their over $62 billion in value, only 3% of that is backed by cash. The rest is backed by various assets, making them more of a hedge fund than a crypto token. A hedge fund with $62 billion in management, only 13 employees, who most people on Wall Street have never heard of. Okay, so that's sketchy, and you can watch CoffeeZilla's video if you want to hear him dive even more into the insane backstory on Tether. But how does all this tie back to Bitcoin? Surely if Tether crashes, that's it. It's bad, like $62 billion in value wiped away bad, but that's relatively small compared to Bitcoin's $600 billion market cap, which isn't directly tied to Tether at all, right? Well, that's where we need to look into the history of Bitcoin crashes. Roughly speaking, we've seen a crypto crash every 4 years, where the price pulls back by usually around 80%. In this latest pullback that we're seeing right now, we've only seen the price decline around 50% so far, and it seems to be pretty stable at this price. Well, in 2014 and 15, the price of Bitcoin dropped following the news of the Mt. Gox scandal, where the largest crypto exchange in the world, handling over 70% of all Bitcoin transactions, was found to have lost 850,000 of its customers' Bitcoins. For scale, that would be worth $28 billion today. In 2018, we saw the last crypto crash shortly after BitConnect was accused of being a Ponzi scheme. Now, I'm not saying that these events caused the crashes, but large swings in investor sentiment can absolutely be triggered by major frauds in related areas, even if it's not the same crypto. Theoretically, BitConnect has nothing to do with Bitcoin, but it being fraudulent, justifiable or not, still hurts Bitcoin as well. Now imagine what would happen to Bitcoin's price if Tether fully collapses, with a valuation of $62 billion absolutely dwarfing high-profile falls from grace in crypto in the past. Not everyone out there has diamond hands, and it would surely spook some people into selling Bitcoin. But in this case, those people selling might have an even bigger impact than you might expect, because of something called market liquidity. Market liquidity is basically how easy it is to buy and sell assets in a market. How much money is there moving around? Right now, Tether has $64 billion in transaction volume each day, more than the total transaction volume of Bitcoin and Ethereum combined. And this makes sense, because people buy Bitcoin as an investment to store value, while they use Tether as something to hold temporarily that won't lose or gain value while they move their money around. So Tether can be thought of as adding liquidity to the Bitcoin market. If Tether disappears, that liquidity disappears. But let's imagine a scenario for a moment. Tether has billions in loans backing their token. But what if one of the companies they loan that money to goes under? Like, say, a sketchy crypto exchange. Well, then those dollars backing the tokens cease to exist. So Tether stops having value and it crashes, which means liquidity in the Bitcoin market dries up. Cryptos start to fall as people panic, and it puts selling pressure on the price of Bitcoin. Well, if there is a large drop in liquidity, any small selling pressure quickly becomes magnified. If panicked people are selling $1 billion worth of Bitcoin, but there aren't enough buyers to pick up that $1 billion, sellers will be forced to accept a lower and lower price. Maybe the first $100 million sells at $33,000 per coin. Maybe the next $100 million sells at $25,000. Maybe the last sells way below that. A lack of liquidity plus sudden buying pressure could be the perfect storm for a huge crash in Bitcoin's prices. And it's hard to say how low they could go. But how could that happen? There's no way Tether's $62 billion could vanish overnight, right? Well, I'll remind you that the SEC investigated a man known as Bernie Madoff and actually cleared him of any wrongdoing before his own $65 billion Ponzi scheme vanished into thin air. And Tether and BitFinex have already been investigated and banned in New York State by the Attorney General, whose report, among other things, said Tether's claims that its virtual currency was fully backed by US dollars at all times was a lie. But there is a ray of hope. While Bitcoin has crashed by over 85% in the past multiple times, it's always managed to recover. And if the price drops incredibly quickly due to a lack of liquidity, over time, new liquidity will likely appear to make up for the void left by Tether's disappearance. So will this crash happen? I don't know. These are not new revelations about Tether. They've been pretty sketchy for years now, and yet their market cap has continued to rise. I think part of the problem is people are making money, and it can be hard to see a problem with something that makes you rich. It's kind of like that Upton Sinclair quote. It is difficult to get a man to understand something when his salary depends on his not understanding it. Well, I wanted to get this video out there because in my mind, the more people who understand what's going on, the better. Don't forget to like and subscribe, and I'll see you next time.